And once you sort of feel more comfortable across the board, I would stay away from these things personally, just because high volatility. As per some business analysts, the rate of interest and gold has a negative. That's why I'm sticking to these highly liquid pairs that are a little bit. Hello friends, welcome back to another video. Today we are going to be talking about the best currency pairs to trade. On this channel, we talk everything about forex trading and tips to help you stay profitable as a forex trader. So if this is your first time coming to my channel, if you don't watch our first video link dropped in cards and description also, you can access directly from there. And these topics on screen. If you are a beginner to trading forex, whether you are one day in one weekend, one month in whatever you're in, I think that it's important to talk about the proper markets to consider when trading. As a beginner, and honestly just trader trading in general, you want to find the best markets that are suitable to yourself. I am telling you now, you are in right path. Let's get into topic without wasting our time. First topic, different types of pairs. Best pairs are chosen according to session you trading. In the market, there are several pairs are available. These are divided into major pairs and minor pairs. Major currency pairs are any pair that include the US dollar, which currently holds the position of the largest economy in the world. Major pairs are the most widely traded currencies in the foreign exchange market. Here are the 7 major forex pairs that are considered to be the most popular across the world. Minor currency pairs, also known as cross-currency pairs, do not involve the US dollar. They pair two other major currencies or a major currency with a currency from a smaller or emerging economy. Here is a list of minor currency pairs. So many traders trade forex market without knowing details of forex pairs. Each pair has its own foundation. It moves based on the foundation. Here foundation means who dragging that pair. For example, a currency runs based on current government policies, their experience in running government, the bank which regulates the country economy, and so on. So many factors decide the movement of a currency. So this is the concept of forex pairs. Let's move to next chapter. Pairs that perfect to your trading. Various markets is that have different behavior. Gold trades differently than the stock market. Stock market trades differently than the Australian dollar. The Australian dollar trades differently than the US dollar. Each one of these markets is like, think of it as like one big family. There's lots of different characters, parameters, and personalities within the family. You might have sort of the more crazy, unpredictable friend, or you might have your colleagues or whatever, right? Each one of them has their own character. And it's going to be important as a new trader, and just as any trader, to pick markets that are suitable to the strategies that you are trading. So here the main factor is based on you. Whether you're familiar with stocks or with currency fundamentals, whatever you trade, you must know the best template that suits your trading style. That's going to be the first point that I have for you before you choose a market to trade. You really do need to make sure that you have a proper trading plan and trading strategy. And most important is you have to have rules-based strategy that stops you over trading, that stops you blowing your account, that protect you from your own emotions. I think you got my point. Before you go jumping into various markets and just putting your hard-earned money on the line. With that said, once you have your trading plan, assuming that you've done some backtesting, you've spent some time, it'll become more clear to you. Over time, which markets are more suitable to you through backtesting and things like that. But today I'm going to give you my picks or pairs that I think are the best or better places for newer traders to explore potential trading opportunities and strategies. With that said, the first thing I want to show you guys is this. I mentioned some markets earlier. I talked about things like gold stock market. There's also the US stock market or Indian stock market. For example, US 30 is an index that a lot of traders like to trade on forex brokers. So you have things like gold US 30, you have things like oil, you have things like GBP, JPI, and in Indian market there are Nifty 50, Nifty 100, etc. And there's something that is a similar trait in all of these different markets. And the main thing is all of these have high volatility, as I covered in my last video. So high volatility is a common factor in all of these markets. Why is that matter? Well, a lot of new traders, they gravitate to these sort of markets. They all want to trade gold and US 30 and oil and Nifty 50 because they sound cool. They're exciting markets to trade. But I will say, I think that this is a very, very dangerous path for new traders because high volatility. What this means is that if you're trading with high volatility, you can make a lot of money in a short period of time trading US 30, gold, and Nifty 50. And that's what attracts new traders. Ultimately, they blow their accounts. They empty their savings. They choose the scary part though, and the part that honestly is where people lose all their money is that with that high volatility, you can very quickly drain a small trading account and lose a lot of money trading these sort of things. They are great when they are going your direction. They are very awful when they are going against you. So I am actually going to say that as a new trader, I would say it's completely better to avoid trading all types of markets. But these high volatility markets, until you know what you're doing, until you feel a little bit more confident in trading execution and how your broker works and MT4. And once you sort of feel more comfortable across the board, I would stay away from these things personally, just because high volatility is really, really bad. Because what happens is with new traders, they often make mistakes. It's very normal for anybody who's getting into this stuff to make mistakes. But learning from mistakes is important. You might accidentally overleverage, or you might accidentally take too many trades or overtrade or get frustrated and make mistakes. And you don't want to be making those mistakes on something highly volatile like crypto. You'll blow accounts and you'll lose a lot of money very, very quickly. So we don't want to be doing that. Instead, in my opinion, I think that it is better to stick to some of the lower volatility markets. At the same time, they must have high volume. So let me list off some of those currency pairs for you. So let's move to next chapter, secret pairs. Some of the markets that I think are a little bit more suitable and a little bit more forgiving for new traders. Assuming you don't over leverage and do stupid things, which by the way, you can lose a bunch of money on any market. But I think that these ones are a little bit more suitable towards beginners. Things like gold, things like GPJPI. Why did I put these? These are less volatile and have more volume, smooth movement and no large pips candles, so that your stop loss can be small. Other side one more to consider would be things like year, CHF. Okay, so a couple things about these pairs. These pairs are inherently higher volatility, okay? They're not going to get wiped out by a gold move that they didn't see coming, and they had no idea why it's happening, and they took a too big position. So here choosing best pairs is not enough. You have managed your risk. Later we will discuss the risk management. So it's probably best in my view to stick to the lower volatility markets. Now, there's also some advantages to things like EURUSD and USDCF specifically. These two are very liquidity. And what I mean by liquidity, if you are not familiar with what I mean, we will discuss this topic also in future videos. First, we're gonna discuss about gold. Central banks maintain reserves of paper currency and gold. The price of gold generally rises as central banks diversify their monetary reserves away from paper currency and towards gold. Several major countries have reserves that are largely made up of gold. Global central banks have acquired the most gold since the United States abandoned the gold standard in 1971. According to Bloomberg's Fundamental Analysis of Gold, with 2019 figures lower than 50-year high set in 2018. According to the WGC Council, in 2019 Turkey was the greatest importer of gold. The next were Russia, Poland, and China. Overall, governments purchased 650 tons of gold in 2019, a slight decrease from the 656 tons purchased in 2018. This is still approaching the highs not seen in 50 years. As per some business analysts, the rate of interest and gold has a negative relationship under normal conditions. A rising yield suggests that the economy is expected to be robust. Inflation is caused by a robust economy. Gold is seen as an inflationary hedge. That makes it one of the factors affecting gold prices. Furthermore, due to the rise in interest rates, traders flock to fixed income investments. Therefore, demand falls while prices stay unchanged. So may factors like this moving the gold and make it one of the best pair. Let's discuss about GBP/JPY. The British pound is the world's fourth most traded currency, whilst the Japanese yen is the world's third most traded currency, resulting in a very liquid and popular currency pair. This, coupled with its consistently high range and volatility, makes it a great candidate for both medium-term and long-term trading, although it is also very popular with scalpers. The GBP/JPY is one of the most widely traded forex pairs. A lot of traders actually prefer it to the major pairs because of the potential it provides. Additionally, trading the GBP/JPY gives you exposure to some of the most important economies in the world. So gold and GBP/JPY, these two pairs are so heavily traded. These are the two major currencies. They're like the some of the two biggest, or I think they are the biggest pairs. So you've got the two biggest currencies trading back and forth. So there's a ton of trading volume. And with that high amounts of trading volume, what that means is that you get low spreads on your broker. When you enter a trade, for example, let's say that you're looking at a chart and you want to buy the gold. So we're looking at XAUUSD and we decide we want to buy this pair. Whenever you enter into a position, if you were to buy this pair, your broker is going to give it to you slightly higher than where you wanted to buy. That is the spread. That's how the broker makes money. Now these spreads, so that distance can be bigger or it can be smaller depending on the pair that you're trading. The volatility in the market, at what time you are trading, the liquidity in the market at the time, how many orders are going through, and so on. And the time of day has a big deal on that as well, as we discussed in last video. By trading the two, you'll pay very little to your broker compared to other markets out there. So these are things to all consider. So by that standard, you're going to be getting into these pairs much easier, much quicker with less spread. So that can be a huge advantage just to sticking to things like gold and very liquid market. And then you have in euro dollar. That's another thing here. We're gonna discuss in next chapter. So let's move to next chapter, reason why I choose these pairs. If you watch this video up to this, I think you might like my videos. Please subscribe to this channel for more content like this. Share this video to your trading friends. Click on bell icon for faster notification when I uploaded videos in this channel. If you're trading, gold and you take a buy trade and then the market goes against you, it might be 10 pips in the span of 2 to 3 minutes. Whereas if you're trading something like Euro USD, let's assume that this was Euro USD, in that same period of time, you might get 30 pips, which can be very, very dangerous. That's why I'm sticking to these highly liquid pairs that are a little bit lower volatility, things gold and GBP/JPY, and go get your feet wet with these things. These pairs are very suitable to our strategy. I am telling this by back testing them. Let's see what I am back testing. See here, I put them in my laptop. I backtested up to 2019. See, I have those PDFs and those backtesting files. These all will available soon. So finally, for beginners, what I am saying is, use a demo account. Don't go put your hard-earned money in the market until you feel comfortable, but try out our concepts on these pairs. And moreover, for our subscribers, I have lot of tools to give you guys for free of cost. They are available to you going through this course. If you want to access them now, then join in our Telegram group. Finally, what I am saying is things are a little bit more calm. That can actually be a huge advantage, especially in this trading game where psychology and getting frustrated and dealing with the mistakes you make as a new trader. Okay, friends, this is the end of the video. Please subscribe to our channel, like this video. Thank you. See you in next video.